Okay, welcome to this video in which we continue with the topic of hedge funds, this time discussing the investment forms and some of the structural aspects of investing in a hedge fund, be it in a direct way or indirect, for example, via a fund of funds. Quite a few specific terms will appear here, so it's worth paying attention. If this is your first video on the Let Me Explain channel, then a warm welcome to the channel. Please consider subscribing to the channel and maybe even joining the channel as a supporting member to get access to a much wider array of CFA related videos. Okay, let's get cracking with the topic. We're going to start off with what your book describes, direct investments, and of course later on we'll talk about the indirect investment forms as well. Of course, we have to remind ourselves that a hedge fund will typically be structured as one of two things. Typically a limited liability partnership, so LLP or limited partnership, but there's also the option to go for a limited liability company, LLC. In fact, those letters are either LP, LLP or LC, LLC, signifying company or partnership with some sort of limited nature or limited liability nature, is a feature of many hedge fund let's say names. Now the fund itself may be registered either in what's known as an onshore location, so kind of on the mainland, so to speak, in a typical location like, let's say, London, the United Kingdom, or the United States, somewhere in one of the locations, or it could be for typically for tax purposes located or registered in an offshore location, where offshoring, like an island location, let's say the Cayman Islands. That's the one that at least comes to my head when I think about offshore locations to register a hedge fund. That comes about, or that the incentive to do it that way comes from various tax advantages, which are not explored in your book. Now, the fund obviously makes investments, and it needs investors. And depending on whether it's a partnership or indeed a company, those investors may be called limited partners, or they could be shareholders, etc. They provide capital, of course. We also need a manager. Now, once again, depending on the actual legal structure of the fund, be it a partnership or indeed a company, that manager could, for example, be the general partner or somebody who is appointed by the general partner to provide management services. In any case, that manager will receive a management fee, which we'll talk about a little bit more in just a moment, and they will also receive performance-based fees, typically known as incentive fees, or an incentive fee, obviously, which they get if they generate good performance, and what that good performance is we'll mention in just a moment. So that's a performance fee or performance-based fee. Okay. Right, and those investors who are the suppliers of capital, they're typically called limited partners in a limited liability structure. They will receive whatever the fund generates, so the fund returns, but minus those fees which need to be paid to the managers, the people running the whole thing. Okay, now for some very specific concepts that you may be asked about in a theoretical question. First of all, please appreciate that it is rare to find a simple structure like this. Most fund structures are actually more complex. And one of the possibilities to make things a little bit more complex is to have what's known as a master feeder structure, which is quite popular. In reality, there are also other possibilities, like to run parallel funds, but that's not explored in your curriculum, but the master feeder structure indeed is. Now, Please note that most of these complexities are done either for legal reasons or tax reasons, or tax efficiency reasons, or both things at the same time. So let me say this is done for tax efficiency. It doesn't necessarily change the way that a fund invests. But what will typically happen in these master feeder approaches or structures is you'll have a master fund. Let's draw it as a bubble. Okay. Which will typically be located onshore. So think about the location like London or New York or something like this. And this is the fund that actually goes and makes typically the investments. Although those investments might actually happen via other intermediate vehicles for legal reasons. Nevertheless, that's the one kind of investing. However, the providers of capital, i.e. the investors, they don't put money directly into this master fund. The investors put money into what's known as a feeder fund. And it's this feeder fund, let's say this is feeder fund A, often located in an offshore or registered in an offshore jurisdiction. The job of this fund is to take or accept money from investors and actually feed that money on to the master fund, which then goes and makes the actual investments. And typically, you'll set up not one, but at least two of these feeder funds. Say this is feeder fund B, also in some kind of offshore jurisdiction, to which other investors will be supplying capital money. And actually, these investors are different than these up here. And the reason you do this is that, hedge fund investors are ultimately quite demanding in terms of meeting certain legal requirements, for example, having the whole structure tuned into their specific needs and requirements from a legal and especially tax perspective. And as you will appreciate, somebody's tax requirements or tax perspective will really depend on where they are, for tax purposes at least, domiciled. So sometimes it's quite difficult to cater to all the needs of the different investors and all those specific details in one fund structure. Making it so universal as to fit everybody's needs probably makes it not so good for other reasons, or you'd kind of dilute the purpose, which is why very often feeder funds are set up with the needs of specific investor groups in mind, or even sometimes a single investor, right, with a very specific requirement, tax circumstances, will want to put money in a fund that's structured according to their needs. But that's not the fund making the investments, that's the fund that just takes the capital and feeds it on to the master fund, where the managers actually perform all the investment decisions. Okay, that's that's going in further than what is in your curriculum. Just be aware of this master feeder structure. Now, another term I want you to be absolutely sort of cognizant of and aware of is something known as the 2 and 20, which is an often cited phrase, let's say. It refers to the fee structure. I said before that those who run the fund will be, will be receiving two types of fees, a management fee and an incentive or performance-based fee. And this 2 and 20 is a direct sort of allusion to that. The first number is 2% management fee, accompanied by a 20% incentive fee, or performance, based fee, performance fee, that's right. Now, that 20% incentive fee means that the manager will get, or should receive, 20% of the net profits, so profits after various costs, generated by the fund, by the structure. Okay. What remains after those fees are accounted for goes to the investors, the suppliers of capital. Okay. Now, maybe it's worth mentioning, because your book does talk about this briefly, that more recently, without going into any specifics of what recent means, the 2 and 20, the typical 2 and 20 structure, which has been around in the industry for quite a long time, has been morphing into the 1 and 30. So once again, the first number would be the management fee, and the second number would be the incentive fee, both being expressed in percentages here. So 1% management fee, 30% incentive. However, the way your book talks about it is that this is the greater of. So managers receive the greater of a 1% management fee and 30% incentive fee. However, whereas before or previously the incentive fee would be based on simply the profits achieved, the absolute profits achieved, these days it's more common to see agreements, or increasingly common to see agreements where this is based on outperformance against a certain benchmark. So not on the whole profit achieved. I pay you. The manager gets a 20% of all the profits, which in a good year would mean a huge amount. If the markets were going up and the fund went up as well in value, huge amounts. But based on outperformance, obviously relative to some chosen benchmark, or based on alpha, which is a measure of how much additional value the fund manager is bringing in against, let's say, relative to a broader market index, for example. Now, don't worry about this. If just be aware of 2 and 20. More recently, moving towards less of a management fee, but more of an incentive fee. I think that should be enough. Now, quite importantly, I think you should be aware of the names of certain legal documents which accompany the formation and running of a hedge fund. Depending on how it is structured, those legal documents will have different names. First of all, because you need to launch a fund, you need to approach investors with some documentation, some legal documentation. So this will often be known as a private placement memorandum, because these vehicles are not launched publicly. So you're placing them. Trying to place the investment privately to a selected group of typically qualifying investors. So a private placement memorandum. In the case of a partnership, you subsequently, once the investor commits to the fund, to making an investment, and they enter the partnership, they sign what's known as a partnership agreement. If it's a limited partnership, then you sign the limited partnership agreement, the so-called LPA, although your book doesn't even cite that name or abbreviation. However, in reality, you would see it if you were doing this kind of thing in reality. If the fund is structured not as a partnership but a company, obviously there is different documentation, like the articles of incorporation. So just a few names: incorporation. Don't worry. I wouldn't suggest ever learning this, sort of memorizing this stuff. Just appreciate that there is a legal document or a couple of legal documents which define the relationship between the fund and the investors, whatever the actual legal form the fund takes. However, what I think you must remember is the role played by something called a side letter or side letters. right? Side letters, that name I think is important. These are specific sort of side agreements which are going to be signed by the fund, but with specific investors. Sometimes specific investors who join the fund, for example, the partnership, will have specific special requirements with regard to tax, maybe liquidity, and you may want to have them on board, grant them certain concessions. Let me give you an example. Normally, when a hedge fund allows investors to liquidate their holdings, so to pull money out of the fund, those investors are subject to a lockup period, and even once the lockup period is over, in which effectively money should not be withdrawn from the fund, once the lockup period is over, you still kind of cannot withdraw money on a day-to-day basis. You have to give ample notice of your intention to withdraw the money, which allows the fund manager to, I guess, more breathing space, more control over how they liquidate certain positions so as to pay you money out. And how much notice you have to give is something that's going to be stipulated in the relevant, for example, partnership agreement if the fund is structured as a limited partnership. It could be 30 days notice or 60 days notice or something like this. But maybe an investor will have a specific requirement that they want from them the notice period to be, of course, to be shorter, maybe like 21 days. Now, in this case, instead of trying to put this into writing and into force at the partnership agreement level, we keep the partnership agreement as it is, stipulating the sort of the general rule, but in a side letter signed with that specific investor, we grant them that concession, which kind of supersedes or overrides what's in the general agreement signed by everybody. So this is to deal with the requirements typically of specific investors, of a specific investor. Okay. And it's done so as to not change and make the whole partnership agreement too big, stipulating all the little details and differences. If it's if a matter is investor specific, we sign a side letter. Now, sometimes that means the investor gets specific rights, like I just mentioned here, right? A shorter notice period, or perhaps better access than others to fund information. Now, don't worry about, what position that puts the other investors in. You're not going to be examined on that, but just be aware of the name side letters. Okay. You also have to be aware of certain things that can be done, let's say, for large investors. If an investor is large, they will typically want or requires more influence over what's going on at the fund than the smaller investors. They want to be sort of more in charge of what's going on, or at least feel that they have some element of influence over how the fund is run. Now, the solution to this problem, as suggested by the curriculum, or the solutions, are twofold. One is set up what's known as a fund of one, and that basically means set up a specific hedge fund for just that one investor. Okay, nice and easy, simple. Ultimately, the solution that gives you the most control over what's going to happen. But the one that definitely gets more attention in the book is something called the SMA. The SMA is a separately managed account. Okay. Now, what will happen here is, in steps, that investor remember, we're talking about typically a large investor for whom this actually makes sense. The investor sets up their own investment vehicle. So this could be a limited liability corporation company or a partnership, whatever. And the day-to-day management of investments done by this investment vehicle is delegated to a hedge fund manager. Okay. Now, you have to be, I have to be careful here to make sure you understand the reality of this. So here's a manager. Okay, that's what I mean by hedge fund manager. That's our manager. And on a day-to-day basis, well, actually, normally they run a hedge fund, to which lots of different investors have put in money, right? And obviously that hedge fund run by the manager or, administered and managed by the manager goes and makes investments. Now, our big, large investor up here doesn't want to be one of the numerous investors just putting money into the hedge fund. They require or they want special treatment, and it's treatment which cannot be solved just by signing a side letter. They require something extra. So what they will do is essentially that large investor, let's draw them down here, is they will set up their own investment vehicle on the side and hire that same manager who's already running this hedge fund to run their investment vehicle as well and make investments. Okay. However, the investments purchased under the SMA, the purchased assets, shares, bonds, currency, whatever, derivatives, the ones purchased for this investment vehicle are held in the investor's name. So they are not sort of co-mingled with the assets held by the hedge fund who has other investors. This is held specifically under or in the investor's name. Okay, so this is the setup. And now I want us to appreciate the pros and cons of this setup known as the SMA. First of all, the positives, the advantages, right? It's a little plus. It allows for definitely a more customized portfolio, because what goes into that separately managed account, this investment vehicle, which effectively is the SMA, doesn't have to be exactly the same stuff that goes into the hedge fund running parallel here. Certain assets may be omitted, others may be added, right? So to better conform to what that large investor wants. Moreover, because those assets are held in the large investor's name, definitely there's better transparency, because that large investor can see what's going on in a much better way, much more direct way than the investors who hold shares or interests in the bigger hedge fund or the other hedge fund. Better transparency, but also better liquidity, because ultimately the large investor can at any point in time decide to liquidate certain positions, and it goes from their own account. What is more, enhanced control by the large investor, right? Okay, exercised by the investor, and typically lower fees as well. Although, that's going to be very structure specific. Having said this, the SMA, right? Remember, this is not your own private hedge fund, and you don't have your own private hedge fund manager. That hedge fund manager is still running the other hedge fund as well. So this actually introduces potentially quite a lot of complexity into the structure, because even though the investor can see what's going on in their overall account, there is quite a lot of demand for oversight of the manager in terms of, am I, the investor, the large investor, being treated fairly in comparison to the other investors who invested in the big fund? Oversight and governance considerations. And, one thing you have to consider is that the hedge fund manager typically also has a personal stake. I mean that they are also an investor in the hedge fund. So they also contribute capital to the hedge fund so as to better align their interests with the interests of the investors. And because they've contributed money to the hedge fund, they want this to perform well. But the hedge fund manager doesn't contribute their own personal wealth into the SMA, that's a separately managed account. And this is where the governance issues or conflict of interest issues come into force, because come into play, because the manager does not have a personal private stake in the SMA, right? They may, that's the manager may, not allocate the best trades to that SMA, the most promising ones. Instead, wishing to favoring the hedge fund, that typical classic structure where they have a personal investment as well. So leaving certain potentially good, profitable investments out of the SMA. So this is where the complexity aspect and oversight aspect and the governance aspect comes into play. Yeah, you'll have lower fees typically in an SMA, but potentially there's less motivation for the manager to act in the best interest of that large investor who owns the separately managed account. And let me just say that this is possible, and your book does mention it. It's possible to solve this problem or try to solve this problem via an incentive fee. But once you start paying the manager an incentive here, the argument of lower fees becomes less of an argument, because you start paying fees just as all the other people. So if you want to have really complete assurance that somebody's acting in your best interest, probably the way to go is to create a hedge fund for one and have a manager who just gets an incentive fee for what they do. An SMA is a sort of solution that sometimes works, but a lot of the time it also creates additional problems like the ones I've just mentioned. Okay, now all of this, what I said so far, were direct or considerations that involve direct investments into specific hedge funds, bigger or smaller. Let us now, just for a moment, discuss indirect investments into hedge funds, and we'll be talking about two ways that your curriculum focuses on. One is the fund of funds approach, and the other is ETFs, which try to emulate and replicate hedge fund performance. Okay, funds of funds, that's the first one. Now, many of you will be aware of the fact that if one wants to invest in a hedge fund, if you want to invest in a hedge fund, you typically have to be quite big in terms of having quite a lot of money to meet the minimum investment thresholds to make that investment possible. And a lot of investors simply cannot afford it, or if they can afford it, it's impossible to diversify it because you have that one investment which you can make, but and you meet the threshold, but others are you don't have enough money to diversify it into others. So the solution to that problem is to not invest directly into a hedge fund, but a fund called a fund of funds that pools money together from smaller institutional investors and actually individual investors typically as well, which then goes on and invests that pool of money into a diversified portfolio of actual hedge funds. So the whole notion here is that this makes hedge fund investing more accessible to smaller investors, smaller institutional investors, and typically individual investors in the first place, as such. Also, not just smaller investors, but investors with less, let's say, expertise into how to individually, less knowledge and expertise about how to choose a hedge fund, and also allows for diversification. Okay, which the investors alone wouldn't be able to achieve given the high entry thresholds, capital entry thresholds at most funds, and the fact that these are relatively smaller investors. Okay, so let's just briefly draw this out, how it would look. In here you've got the investors, multiple investors, all pooling their money together, or putting their money into a fund of funds. And that fund of funds with the money goes and makes investments into actual hedge funds. Hedge fund A, hedge fund B, and so on. Often, hedge funds following different strategies so as to have those benefits of diversification. Now, it's not just diversification that we get here, because very often that fund of funds uses its sort of weight to typically negotiate. So typically it negotiates better terms. Better terms than would be possible for the individual investors to negotiate. So better terms in terms of the minimum investment required, the threshold, but also things like lock-up periods. Something we mentioned before. These guys, this fund of funds, may have a better negotiated ability to liquidate their positions in a hedge fund. And the whole idea also, let's not lose sight of this, is that the people running the fund of funds, they ideally should have a lot more expertise in selecting hedge funds and knowing which funds are good, which managers are good, definitely better than the individual investors would have on their own. So better expertise in, fund due diligence, checking funds out and screening them against various criteria. Obviously, the flip side is, if you've got somebody in the middle, an intermediary, that's going to add an additional layer of fees. So that's unavoidable, additional fees. Obviously, on top of those, which will nevertheless still be charged by the sort of ultimate hedge funds who are doing the investing. And something you'll often see being, at least in the curriculum, used is the 1 and 10. So 1% management fee charged by the fund of funds, and a 10% incentive fee on top of the fees like the 2 and 20 or the 1 and 30 charged by those ultimate hedge funds. Now, this is the one of the indirect investment forms discussed in the curriculum. There's another one, but it's a lot sort of less detailed, a lot quicker. ETFs. Your book does mention exchange-traded funds, a relatively recent phenomenon in terms of funds. Maybe not ETFs being relatively recent, but funds, ETF funds, sorry, that attempt to replicate or emulate hedge fund strategies. And also the returns achieved by actual hedge funds. However, because these are ETFs, their shares trade on an exchange. So from an investor's point of view, the investor gets definitely much better liquidity. They're not subject to lockups, things like that. These come with much lower fees than an actual hedge fund, and definitely greater transparency. The problem is, typically, the returns achieved by these ETFs are not as good as those achieved by the fund whose strategy they are trying to emulate, or a fund that would be running that strategies under normal hedge fund conditions. So returns often fall short of what would be achieved by an actual hedge fund running the same strategy. And this is typically due to a couple of considerations. First of all, ETFs are subject to a lot more regulatory scrutiny, so greater regulatory burden, which adds a layer of costs, for example. These funds are liquid, so there are no restrictions on redemptions here. And that means these funds will often have to liquidate positions and open positions depending on the flow of money in and out, something that hedge fund managers do not face, at least to that extent. And once again, because of the public nature of ETFs, they will not be as able as a typical hedge fund to use leverage, definitely not to the same extent. So inability to use and rely on leverage to the same extent as an actual hedge fund would.